Hi, my name is Gail Wosnitza, and I'm a tax partner with Raymond Chabot Grant Thornton. Today we're going to be discussing the tax treatment of travel expenses for employees in the construction industry with a goal to try to maximize these deductions. This presentation deals with a complex subject matter. The attached documentation is based on tax legislation and administrative positions that are subject to change. This presentation is general in nature and should not replace the advice of professionals specializing in taxation matters. While reasonable care was used in preparing this presentation, the participants accept no legal responsibility for the information contained herein and disclaim liability for any damages resulting from its use. In today's presentation, we're going to discuss the course objectives, the tax treatment for employee travel expenses, as well as we're going to discuss certain technical interpretations that were issued by the taxation authorities and the prescribed forms that need to be used in order to record such expenses. The objective of our presentation today is to review the tax rules for automobile expenses claimed by construction employees. This is general information. Please do not hesitate to contact your tax professional for specific advice. We'll look at the tax rules related to employee automobile expense claims. We will begin today by looking at what is considered as an automobile for tax purposes. An automobile is generally defined as a motor vehicle designed to carry individuals with a seating capacity of not more than the driver and 8 passengers. It excludes things such as an ambulance, a taxi, a hearse, a minivan or pickup truck with 3 seats or less that is being used primarily to transport merchandise, a minivan or pickup truck, the use of which is all or substantially all for the transportation of goods or passengers, a police car, or a fire emergency response vehicle. Also excluded is a pickup truck that is used primarily for the transportation of goods or equipment in the course of gaining or producing income at a location that is a special or remote location, or a location that is at least 30 kilometers outside the nearest point of the nearest urban center. Now that we've discussed what is considered as an automobile for tax purposes, let's look at the 3 conditions needed in order to deduct automobile expenses. An employee may claim the expenses of his automobile used in the connection with his employment if the following 3 conditions are met. The employee is usually required to work away from the employer's place of business. The employment contract requires that the employee pay his or her own automobile expenses. And the third is that the employee has not received a non-taxable allowance for the automobile expenses. Now that we've discussed what is an automobile and what are the conditions that are required by the employee in order to deduct such expenses, let's have a look at what eligible expenses consist of. When we're dealing with a leased automobile, we can deduct leasing expenses, which include any costs associated with the lease, such as the maintenance contracts, the penalties for excess kilometerage, the terminal charges. However, the amount that can be deducted is subject to a limit, and the maximum deductible monthly leasing costs in 2011 are $800 a month plus sales taxes. So that becomes $911, including GST and QST. As well, you have to look at a formula, and therefore you'll need to know what the manufacturer's list price is in order to make sure that the formula is not less than the $800 limit. The $800 limit depends as well on the date of the leasing contract. So the $800 that we were discussing relates to leases that were signed in the 2011 year. If an employee has a lease that has been signed in the 2009 year, he has to look at the lease contract in the 2009 year and what the limit would have been in that year in order to determine his maximum deductible lease costs. For automobiles that have been purchased, the deduction that can be claimed by employees is based on the purchase price of the car. However, the purchase price of the car is limited to a maximum. In the 2011 year, the maximum purchase price is $30,000 plus sales taxes. So that would be $34,177. If the cost of the automobile is less than $30,000, the cost of the automobile is included in Category 10 for capital cost allowance purposes. So that's the depreciation that we claim for tax purposes. If it's equal to or greater than the $30,000 limit, then the $30,000 limit is included in Class 10.1. The importance of those 2 categories are that both of them allow you to deduct 30% declining balance for depreciation related to the automobile, but the rules related to the sale of the automobile are different depending on whether it's included in Class 10 or Class 10.1. As well, ineligible expenses include financing charges, and again, those financing charges are limited to $10 a day or a maximum of $300 per month. Other eligible expenses include the operating costs of the automobile, which would include the gas, the oil, maintenance and repairs, license and registration, insurance, as well as the Odotrack fees. Furthermore, accident repair expenses are deductible in full, but only if the car was being used to earn income from business or employment at the time the accident was incurred. Non-eligible expenses would include expenses relating to any traffic violation or fines, as well as accident repair expenses if the vehicle was being used for personal purposes at the time of the accident. In addition to deducting expenses, an employee can deduct certain rebates related to GST and QST. However, there are certain conditions that must be met in order to deduct those expenses, and we'll go through those conditions right now. The first condition is that your employer must be a GST or QST registrant and cannot be a designated financial institution. So employees can claim a rebate for taxes on the cost of the automobile, but not based on the purchase price of the automobile, based on the tax depreciation that's claimed every year, as well as other automobile expenses based on the deductible portion of the expenses. In order to claim these expenses, an employee must fill in certain prescribed forms. For GST purposes, this is GST 370, and for QST purposes, the form is VD 358. So the question to be answered for a construction employee is, what is the employer's establishment? Where the employee goes to different work sites at different times during the year. So generally, for example, an employee who travels to the same work site for, say, a period of 3 months, this would be considered that he is traveling to his employer's establishment, and the travel between his home and such work site would be considered to be personal use of his motor vehicle. On the other hand, if an employee goes site to site for a temporary period of time, say, for example, an employee might go to a work site for 1 week in Montreal, and the next week he might go to a work site in Quebec, the travel between his home and those work sites would be considered to be employment use of his motor vehicle. We'll now look at the calculation of the actual deduction for the automobile expenses. So in the case of an employee who purchases an automobile, the expenses that are deductible would be the operating expenses, the capital cost allowance, and the interest, times the proportion of employment usage of his motor vehicle over the total usage of his motor vehicle. In the case of an employee who leases his automobile, then he can deduct his operating costs, his leasing costs, again, times a proportion of the usage of his vehicle, which is the employment usage of his vehicle over the total usage of his vehicle. As well, any parking costs incurred during travel for employment are also deductible. The next thing that we're going to look at is the tax treatment related to allowances that employees may receive from their employers to compensate them for the use of their personal vehicle. So an allowance is generally an amount paid by an employer to an employee to compensate for the expenses incurred by the employee during the course of his office or employment without having to justify its use. There are basically two types of automobile allowances that can be paid. One is based on business kilometers driven, and the next is a fixed allowance that can be paid. When we look at an allowance based on kilometers driven, such an allowance is considered reasonable if it is computed solely by reference to the number of kilometers driven in connection with employment. Accordingly, it's necessary for employees to keep a logbook of their actual kilometers driven to justify the fact that the allowance should not be taxable. A reasonable allowance based on business kilometers driven is not taxable to the employee. Now we're going to look at the treatment for the employer who pays an allowance based on kilometers driven. An employer can deduct a maximum amount paid to his employees. And in 2011, the maximum is 52 cents per kilometer driven for the first 5,000 kilometers and 46 cents per kilometer for each additional kilometer. A fixed allowance, on the other hand, is a predetermined amount that is paid out to an employee without taking into account the kilometers driven. So, for example, a payment of $100 a month to an employee to compensate him for the use of his motor vehicle will be considered to be a fixed allowance. Such allowances are taxable, and the employee may deduct automobile expenses if all the other conditions are met against that allowance. The next thing that we're going to look at are some specific tax rules and technical interpretations issued by the tax authorities that are specific to the construction industry. Under certain collective agreements, there are predetermined amounts of allowances paid to construction employees. This is referred to as the R20 regulation, and the slide there is a recap of such allowances. The allowances are paid depending on the construction sector, as well as based on the kilometers driven. The rates that you're looking at are those in effect as of May 1st, 2011, for sites located in Quebec City, Trois-Rivières, Montreal, and Eastern Townships. So, for example, an employee who is working in the light residential sector, as you can see on the screen, is not eligible for any allowances under this regulation. Whereas an employee who's working in the heavy residential sector has the right to an allowance after 40 kilometers. then the amount is 44 cents per kilometer. For employees working in the commercial, industrial, and civil engineering sectors, the allowances are paid after 60 kilometers, and they are based on amounts paid per day. So they vary between $31.60 per day or $37.63 per day. In order to clarify the taxation of the allowances that we discussed in the previous slide, a number of requests were submitted to Revenue Canada and Revenue Quebec, covering a number of situations that affect construction industry employees. So the first question that was asked, can an employee exclude from his income an allowance paid by his employer and still claim a deduction for a portion of travel expenses for which no allowance was received? So for example, an employee who doesn't receive an allowance for the travel for the first 40 kilometers, can he claim his expenses related to that travel? According to Revenue Canada, the 44 cents a kilometer seems to be reasonable, and therefore the allowance does not have to be included in income. However, the employee may not deduct any expenses related to that travel. But an employee can deduct the expenses for the portion of travel under 41 kilometers, for example, where no allowance was received, assuming that other conditions were met. Revenue Quebec agrees with that position. Alternatively, could it be said that the employer's allowance is not reasonable because it does not cover all of the employee's travel expenses between the employer's residence and the construction site? Although the employer pays a travel allowance, could the employee include the allowance in his income and claim a deduction for all of his travel expenses incurred in the course of his employment? The federal position is, because the allowance is reasonable, the employee cannot elect to include it in his income and then claim a deduction for all travel expenses to and from the construction site. Revenue Quebec agrees with that position. So to summarize, an employee cannot voluntarily include an otherwise non-taxable amount in his income and deduct expenses against that. So the next question that was asked relates to Type 2 construction employees in the commercial and institutional sector. If you recall, these employees are paid a fixed amount per day that varies between $31.60 to $37.63. So the question that was asked was, is the allowance paid by the employer an allowance calculated solely by reference to the number of kilometers for which the vehicle was used by the employee in the course of employment? The response from the federal taxation authorities was that the allowance is deemed not to be reasonable unless it is calculated solely by reference to the number of kilometers for which the vehicle was used by the taxpayer in the course of the taxpayer's employment. Therefore, a fixed amount of $31.60 or $37.60 is therefore taxable because it is deemed not to be reasonable. For Quebec purposes, the taxpayer doesn't have to question as to whether the allowance is reasonable. It is not included in calculating income specifically because it is prescribed by the Income Tax Act, the Quebec Taxation Act. The next question also related to Type 2 construction employees. The question was, if the allowance is considered reasonable, can the employees exclude it from income and claim a deduction for the portion of the travel expenses not covered by the allowance, i.e. the costs incurred for travel of less than 61 kilometers? In the opinion of the federal government, since the allowance is not reasonable because it's not calculated solely by reference to the number of kilometers for which the vehicle was used in the course of employment, the employee must include the employer's allowance in income and can deduct all deductible expenses, assuming that all the other conditions are met. For Quebec purposes, the employee can only deduct expenses for the portion of travel that is not covered by the allowance because, as you'll recall, such allowances were not taxable for Quebec purposes, but they were taxable for federal purposes because they are paid on a daily basis. The next request for technical interpretation covered the case of employees who did not request an allowance from their employer. So the question was, even though they're entitled, can such employees claim a deduction in calculating income for all travel expenses incurred in the course of employment? For federal purposes, the answer was a Type 1 employee can only claim the portion that is not covered by the agreements, the travel less than 41 kilometers. A Type 2 employee, because the allowances are not reasonable, can include the allowances received and deduct expenses actually paid. For Quebec purposes, since the agreement provides for an allowance related to certain types of travel, they consider that the employee is not required to pay such travel expenses, and accordingly, such expenses are not deductible. The next request for technical interpretation also covered the case where employees had the right to claim travel allowances under the collective agreements but did not do so. So the question was, if not, can the employees claim net travel expenses incurred in the course of employment That is the total expenses incurred less the amount that would have been claimed by the employer under the applicable collective agreement. For federal purposes, a Type 1 employee can only claim the portion that is not covered by the collective agreements. Because the allowances are not reasonable, a Type 2 employee can include the allowances received and deduct the expenses actually paid, assuming that all other conditions are met. For Quebec purposes, an employee cannot claim a deduction for travel expenses for which the employee could receive an allowance under the collective agreement, because the employee is not required to pay such expenses. The next three requests for technical interpretation deal with what is considered to be business or employment travel. So the first question was, if an employee makes a stop on his way from home to the worksite and back for personal reasons, for example, to drop off a child at a daycare, is the employee considered to travel in the course of employment from home or from the drop-off location? What if the drop-off location is further from the construction site than the employee's residence? What if the drop-off location is closer to the construction site than the employee's residence? The answers to these questions were, for federal purposes, travel for personal reasons is excluded. For Quebec, regardless of the distance between the daycare and the residence or construction site, distance is calculated between the residence and the construction site along a standard route. So basically, the answer for federal and Quebec purposes is the same. So for example, if the daycare is situated between your home and the construction site, the distance is calculated between the home and the construction site. If the daycare is situated beyond the construction site, again, the kilometers driven for employment purposes that we look at is the distance between the home and the construction site. The next slide is a recap of the tax treatment for employees in the construction sector who are covered by the collective agreements. There are three tax treatments. One is the automobile expenses may be deducted by such employees. The second is the automobile expenses may be deducted and the allowance received must be included in income. And the third is the automobile expenses may not be deducted as the allowance is not taxable. As you'll note on the slide, employees in all sectors who travel less than 41 kilometers can deduct their automobile expenses because they don't receive any allowance, as well as employees in the light residential sector. They didn't receive an allowance, therefore they can deduct their automobile expenses. The next thing that we're going to look at is what forms need to be used in order to deduct the expenses, as there are certain prescribed forms in the Income Tax Act. So to claim automobile expenses, a duly completed form must be signed by the employer to attest that the conditions have been met in order for the employee to deduct his expenses. Federally, the form is Form T-2200, and provincially, the form is TP 64.3. Furthermore, an employee who is going to incur deductible automobile expenses can request a reduction in his payroll deductions at source. But in order to do so, the employee must complete two forms and submit them to his employer. Federally, the form that needs to be completed is the T-1213, and provincially, Quebec-wise, the form is TP-1016. The benefits of requesting a reduction in payroll deductions at source are there's an immediate increase in the net pay rather than waiting to the end of the year for a refund. As well, the increase in the net pay can be used to pay the Odotrack monthly fees for the employee. This brings to an end our presentation. We hope it is useful in determining the tax treatment of your travel expenses and determining how to maximize your deductions. Raymond Chabot Grant Thornton can assist you in these and other business areas.